Hold on to your hats, folks. Wall Street just took a nosedive and it's making investors sweat. On March 28, 2025, the market experienced a massive sell-off. Fears are swirling about inflation and tariffs. This one-two punch sent shockwaves through the financial world. We're talking about a major blow to investor confidence. The question on everyone's mind is simple: how bad will it get? Let's cut to the chase and look at the cold, hard numbers. The Dow Jones Industrial Average plummeted by a gut-wrenching 700 points. That's a drop of 1.7%, folks. The S&P 500, a broader measure of the market, didn't fare much better, shedding 2% of its value. But wait, there's more. The tech-heavy Nasdaq Composite got slammed with a 2.7% loss, the worst performance of the major indices. And the VIX, also known as the market's fear gauge, shot up by almost 3 points. That's a telltale sign that investors are running for cover. So what's fueling this market meltdown? One word: inflation. The latest reading on the Personal Consumption Expenditures (PCE) index, the Fed's preferred inflation measure, came in hotter than expected. The monthly increase of 0.4% for February sent shockwaves through Wall Street. Why? Because it means the Fed's battle against inflation is far from over. And that means interest rates could stay higher for longer, putting a damper on economic growth. As if inflation worries weren't enough, we've got another problem on our hands: tariffs. Remember those tariffs on foreign-made autos that President Trump announced? Yeah, they're starting to bite. And it's not just autos. There are whispers of even more tariffs on the horizon, including reciprocal tariffs set to kick in on April 2nd. This uncertainty over trade policy is making investors nervous. Section 5: Consumers feeling the pinch. It's not just Wall Street that's feeling the heat. Consumers are getting squeezed too. The University of Michigan's Consumer Sentiment Index tumbled to 57 in March, the lowest level since November 2022. Ouch! People are worried about inflation eating away at their paychecks. Job security is also a concern, with many folks bracing for potential layoffs. This toxic cocktail of fear and uncertainty is bad news for the economy. Section 6: Tech and discretionary stocks hit hard. When the market goes south, some sectors get hit harder than others. And this time, it's tech and consumer discretionary stocks that are taking it on the chin. Apple, Microsoft, Amazon, they're all down big. Lululemon, the athletic apparel maker, got clobbered after slashing its annual forecasts. Consumers are tightening their belts, and discretionary spending is the first thing to go. Section 7: Fed on high alert. The Federal Reserve is watching all of this very closely. With inflation still running hot, the Fed is likely to keep its foot on the brakes. That means more interest rate hikes are probably on the way. The Atlanta Fed's GDP Now Index, a closely watched economic indicator, is now predicting a 2.8% decline in first quarter GDP. That's a big red flag. Section 8: Analysts sound the alarm. Wall Street's finest are starting to sound the alarm bells. UBS, one of the world's biggest banks, just lowered its year-end target for the S&P 500 to 6,400. That's a significant drop from its previous target of 6,600. Goldman Sachs and RBC Capital Markets have also revised their forecast downward. The message is clear. Buckle up, folks. It's going to be a bumpy ride. Section 9: Navigating the market storm. So, what's an investor to do in these turbulent times? First, don't panic. Second, remember that bear markets are a natural part of the economic cycle. Now is the time to be cautious and selective. Look for companies with strong balance sheets, pricing power, and solid fundamentals. And most importantly, stay informed and stay invested.